Hi, my name is Jeffrey Chen. I'm from Newport High School, which is in Bellevue, Washington, United States of America. The topic I'm going to discuss with you today is deregulation and the 2008 financial crisis. It is about how deregulation broke financial regulatory barriers and literally destroyed the U.S. economy. Financial regulations created a legal barrier that safeguarded the U.S. economy for 4 decades after the Great Depression. However, after the 1970s, pro-deregulation advocates began to argue that financial regulations restricted the competitiveness of American banks in the global economy. The financial deregulation movement, symbolized by the passage of the Gramm-beach-Biley Financial Services Modernization Act of 1999 and the revocation of net capital in 2004, gradually broke through these long-standing regulatory barriers. For a short while, deregulatory policies stimulated impressive economic growth. However, this temporary prosperity was subsequently overshadowed by the greatest financial disaster in modern history, which literally destroyed the U.S. economy in 2008. During and after the crisis, several remedies were implemented, including enormous bailout of the U.S. financial sector and introduction of new regulatory legislation, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. Since then, many new regulations have been proposed, and there have been debates over whether they are both effective and well suited for modern world of banking. The 1929 stock market crash precipitated cataclysmic economic depression. The blame was placed upon the consolidation of commercial investment banking interests, especially after the Pecora hearings held between 1932 and 1934. In those hearings, Ferdinand Pecora, chief counsel of the Glass Committee of Congress, uncovered various abuses involving large banks and securities affiliates, most notably National City Bank and Chase National Bank. In the wake of those damning revelations, general consensus shifted strongly in favor of separating commercial and investment banking. Senator Carter Glass proposed a regulatory barrier between the two sectors. In 1933, his legislation, the Banking Act, Glass-Steagall, was passed by Congress and signed into law by President Franklin Roosevelt. In addition to separating commercial and investment banking, Congress also passed the Securities Act of 1933. This law empowered the federal government to oversee securities trade and required securities traders to provide potential investors with accurate and comprehensive information about the relevant securities. To ensure the full enforcement of the 1933 Securities Act, Congress also passed the Securities Exchange Act of 1934, which established the Securities and Exchange Commission to oversee securities, as well as markets and the conduct of financial professionals, and to compel all companies listed on stock exchanges to comply with its rules. After these vigorous efforts, a primitive barrier was established in America to safeguard the financial industry and prevent the mistakes of 1929 from being repeated. The U.S. did not have a single financial crisis during the 4 decades after the Great Depression, when the financial industry was tightly regulated. Despite this impressive record, from the 1980s to the 2000s, a deregulation movement slowly grew, with Congress repealing many Depression-era regulations. 1970s-era stagflation made many economists lose faith in the Keynesian model of government intervention in the economy. This led to an increasing hostility towards regulation, spearheaded by the Chicago School of Economics. Proponents of Laissez-faire economics argue that in the wake of globalization, antiquated financial regulations prevented U.S. banks from competing with less regulated foreign banks. Later on, Laissez-faire economists attribute the impressive economic growth of the 1980s and 1990s to financial deregulation enacted by the Reagan and Clinton administrations. Although laissez-faire economics was hardly a new idea, it had been previously marginalized in favor of Keynesian economics. The renewed popularity of free market theories was not just a result of 1970s stagflation, but also the outcome of increased corporate influence over both the Democratic and Republican Party. In 1980, when Ronald Reagan was elected president, he escalated the deregulation of the financial industry to an unprecedented degree. Prior to the Reagan era, investment banks were small private partnerships in which the partners contributed their own money and thus always attempted to avoid taking aggressive risks. When those very banks went public, huge amounts of shareholder funds began flooding in, and the banks increased in size dramatically. In 1982, Congress passed the Garn-St Germain Act, which allowed banks to issue adjustable rate mortgages and drastically changed the mortgage industry. Although adjustable rate mortgages helped many Americans buy their own homes. During the 2000s housing bubble, they were exploited by subprime mortgage lenders, who left borrowers at the mercy of the volatile market after initially low interest rates expired. In 1987, President Reagan appointed Alan Greenspan, a staunch opponent of regulation, as the chairman of the Federal Reserve. Greenspan helped thwart attempts by the Federal Reserve to regulate the financial industry. Notably, he delegated regulatory responsibility to the Federal Reserve Bank of New York, which was a private corporation with a board of directors made up of bankers inimical to government regulation. Later, despite being given the power to do so by the Homeownership Equity Protection Act of 1994, Greenspan did not regulate the mortgage industry during the 2000s housing bubble, or mitigate its risks by mandating higher down payments on homes. He also refused to require higher margin requirements for stock trading or rating the derivatives market. Ultimately, these actions played a key role in causing the 2008 financial crisis. The election of Bill Clinton only strengthened the tide of deregulation. President Clinton believed that in a modern economy, the best way for American finance to remain globally competitive was to eliminate barriers that might choke a bank's efficiency, such as depreciating financial regulations. To advance his policy agenda, he appointed Robert Rubin and Larry Summers, both staunch regulators, as his first and second secretaries of the Treasury. Among many regulatory laws that Clinton signed was the Riegle-Neal Act of 1994, which repealed the McFadden Act of 1927, a law that banned interstate banking. In 1998, the commercial bank Citicorp and insurance firm Travelers Group merged to form Citigroup, an action that was illegal under the Glass-Steagall Act. Alan Greenspan, a vocal opponent of the Depression-era banking law, granted the merger a one-year exemption, during which Deputy Treasurer Summers and Treasurer Rubin successfully urged passage of the Gramm-beach-Biley Financial Services Modernization Act of 1999, also known as GLBA. This law overturned sections 20 and 32 of the Glass-Steagall Act, which prevented mergers among investment, insurance, and commercial banks. One of GLBA's staunchest opponents, Senator Byron Dorgan, complained that the law would allow banks to become too big to fail. However, over obstructions, the bill was passed by Congress and signed into law by President Clinton. Under the Riegle-Neal Act, banks could now expand by opening branches across state lines, and GLBA allowed investment, commercial, and insurance banks to consolidate into a single entity. Consequently, the assets under management of the six largest banks grew from 20% of GDP in 1997 to 60% of GDP in 2008. When these banks became too big to fail, they started making risky decisions. They knew if they ever failed, the government would have no choice but to bail them out. Otherwise, their collapse would enormously impact the economy. But in the 2008 financial crisis, when the Federal Reserve refused to bail out Lehman Brothers, Lehman was pushed into bankruptcy, and the collapse of the financial sector subsequently occurred. As a result, the entire economy came crashing down as well. In May 1998, concerns over the risk posed by new financial instruments called over-the-counter derivatives prompted Brooks Born, the director of the Commodity Futures Trading Commission, to issue a proposal for regulating derivatives. However, the Treasury, Federal Reserve, and SEC all rejected Bourne's proposal, and in December 2000, at the urging of Senator Phil Gramm, Congress passed the Commodity Futures Modernization Act, which banned further regulation of the derivatives industry. During that period, banks invented two kinds of derivatives: collateralized debt obligations, CDO, and credit default swaps, CDS. Under a process called securitization, mortgage lenders sold their mortgages to investment banks, who then combined them into tradable securities called CDOs and sold their shares to investors. This process transformed mortgages from strictly regulated long-term commitments between lenders and borrowers to shares owned by many investors. A CDS is basically an insurance policy against the possible default of a CDO. Like other derivatives, CDOs and CDSs were complicated and sometimes extremely risky. Furthermore, investment banks created many additional derivatives around the same CDOs, which greatly amplified the impact in case the underlying CDOs failed. Ultimately, this precarious, unregulated market caused many investment banks and insurance companies to collapse in 2008. The net capital rule was implemented by SEC in 1975 to help banks manage investment losses by mandating a capital cushion. But this requirement also sharply reduced banking profits. Thus, Henry Paulson, the CEO of Goldman Sachs, lobbied the SEC to relax the rule and allow banks to greatly increase their leverage ratio. On April 28, 2004, the SEC repealed the net capital rule and lifted leverage limits on investment banks. Subsequently, the leverage ratio for some banks rose to 33-1, which meant that a tiny 3% decrease in asset-based value will implode the bank's financial position. This precarious leverage ratio was one of the major reasons why so many banks, including Bear Stearns and Lehman Brothers, encountered trouble in 2008. Besides dismantling regulative barriers, the reluctant enforcement of regulations also contributed to the 2008 financial crisis. During the housing bubble, the SEC did not initiate any investigations into investment banks, even when it became clear that the banks were trading junk securities. Additionally, many renowned credit rating agencies, such as Standard & Poor's, Fitch, and Moody's, gave AAA ratings to risky and complex CDOs. Despite inflated ratings, however, no serious actions were taken to regulate these agencies, even though Sarbanes-Oxley, a 2002 law that expanded federal oversight of corporations, contained the provision requiring a commission study regarding credit rating agencies. In 2008, following a collapse in the subprime mortgage market, many renowned investment banks and insurance companies imploded. The failure of the financial industry triggered the collapse of the real economy, plunging America into a large-scale recession. In the 1990s, Fannie Mae and Freddie Mac, two government-sponsored mortgage lenders, embarked on an ambitious mission to expand homeownership. The result was the single largest housing bubble in history. Fannie Mae CEO James Johnson successfully lobbied the government to lower Fannie Mae's underwriting standards from at least a 20% down payment to one of only 5%. Also, in a program called Alternative Qualifying, Fannie Mae relaxed numerous lending rules, such as analyzing the risk of a potential borrower. These practices encouraged the blossoming of the subprime market, which helped many Americans buy their first home, but also generated enormous risks that contributed to the 2008 financial crisis. In 2006, when the housing bubble burst, house prices dropped and interest rates began to rise. A wave of defaults and foreclosures soon hit the United States, causing huge losses among subprime lenders and CDO investors. Demand for CDOs halted abruptly, and in July 2007, two of Bear Stearns' hedge funds went bankrupt. The high leverage ratios of Bear Stearns now dragged the bank to the verge of bankruptcy. On March 17, 2008, Bear Stearns was sold to JP Morgan at $2 a share, a deal backed by a Federal Reserve bailout. On September weekend that same year, Henry Paulson, now Secretary of the Treasury, and Timothy Geithner, President of the New York Federal Reserve, called an emergency meeting with CEOs of major banks to rescue Lehman Brothers and Merrill Lynch. Both of these banks had deep financial troubles, a result of their previously lucrative securities becoming worthless with the subprime market crash. As a result of that meeting, Merrill Lynch was acquired on Sunday, September 14, by Bank of America. But when Barclays, a British bank, tried to buy Lehman Brothers, the deal was rejected by the British government. The British government wanted a financial guarantee from the US government to ensure any acquisition would not potentially destabilize the British financial sector. But unlike what he did with Bear Stearns, Paulson refused to demand for a guarantee, so the deal fell apart. Following the setback for Lehman Brothers, the Federal Reserve demanded the bank file for Chapter 11 bankruptcy before midnight September 14 to calm the markets hurt by its falling stock prices, although Lehman's CEO Richard S. Fuld objected, warning that the bankruptcy will only disrupt the markets further. On September 15, Lehman Brothers filed for bankruptcy. In the meantime, banks such as Morgan Stanley and even Goldman Sachs had massive capital deficits as well. The failure of Lehman Brothers triggered the crash of the commercial paper market, which put a halt to many business operations across the US and forced massive layoffs. At the time, insurance giant AIG had sold many CDSs to investment banks, expecting that a massive wave of defaults was impossible. However, the huge failure of underlying CDOs meant that AIG was unprepared to pay off all the CDSs it had sold. This nearly caused the company to go bankrupt, which paralyzed many insurance-backed businesses, including the airline industry. The failure of Wall Street ultimately crippled Main Street, as the unemployment rate rose to over 10%, and foreclosures reached 6 million by early 2010. The US economy had been nearly decapitated. During and after the financial crisis, the government offered enormous bailouts and introduced new regulations to prevent the same mistakes from happening again. On September 7, 2008, Henry Paulson, now treasurer, announced the takeover of Fannie Mae and Freddie Mac, both of which were about to collapse. On September 16, the Federal Reserve agreed to give AIG an $85 billion loan and took over the distressed company in order to prevent a total implosion of the US economy. On September 18, Paulson and Federal Reserve Chairman Ben Bernanke asked Congress for a $700 billion bank bailout to forestall a catastrophic economic collapse. About 2 weeks later, on October 4, President Bush signed the Emergency Economic Stabilization Act of 2008, which set up the Troubled Asset Relief Program, TARP, to purchase toxic assets, namely now worthless CDOs and CDSs, from the beleaguered banks. This included the bailout of AIG, which ultimately cost taxpayers over $150 billion. After Obama became president of the United States, his treasury instituted a public-private investment program to increase the liquidity of the toxic assets held by banks, euphemistically dubbed legacy assets. Although PPIP's stated purpose was to complement TARP by buying legacy assets from financial institutions, Nobel Prize economics Paul Krugman charged that its actual purpose was to subsidize shareholders, asset managers, and creditors to non-recourse loans, which would encourage extreme bidding of assets. In 2010, President Obama signed the Dodd-Frank Wall Street Reform and Consumer Protection Act into law. Dodd-Frank further empowered the Federal Deposit Insurance Corporation with new responsibilities, gave the Federal Reserve new powers to regulate banks, created the Consumer Financial Protection Bureau, and repealed regulatory exemption for the derivatives industry. One specific provision in the Dodd-Frank Act was the Volcker Rule, which, much like Glass-Steagall, prevents banks from using depositor money to advance corporate profits and prohibits banks from owning, investing in, or sponsoring hedge funds and liquidity funds. Although Dodd-Frank introduced many important reforms, some have criticized the law for not fully restoring the financial regulatory barriers that once protected America, or preventing the increasing concentration of the financial industry within a few big banks. In summary, financial deregulation and the refusal to enact new modern rules contributed significantly to the 2008 financial crisis. For 4 decades after the Great Depression, regulatory barriers enacted by Congress safeguarded America from financial crises. Starting in the 1980s, the deregulation movement gradually broke through these barriers. Pro-deregulation advocates argued that the financial regulations restricted the competitiveness of American banks in the global economy. For a short while, financial deregulation stimulated impressive economic growth. In the long run, however, deregulatory policies created more risks and problems than benefits. The temporary prosperity of the Reagan and Clinton years was subsequently overshadowed by the greatest financial disaster in modern history, which nearly destroyed the US economy in 2008. Since then, people have been questioning how best to craft new regulations that are both effective and well suited for a modern world of banking. Several proposals have been put forward for reforming the financial sector. The following is a short list. The 21st Century Glass-Steagall Act. Reform incentive payment structure. Challenging financial lobbies. Regulating credit agencies. And that concludes my presentation. Thank you all very much for listening.